Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A tech bloodbath rocks Wall Street as rate cut hopes evaporate, sending the Nasdaq plunging. But beneath the chaos, a massive capital rotation is creating new kings. Where is the smart money fleeing? Second, alert. Wall Street titan Gundlach warns of a 2008-style crisis in the $1.7 trillion private credit market. He's calling it the next subprime mortgage catastrophe, but why is the rest of Wall Street ignoring the alarm bells? We reveal the hidden dangers that could blindside millions of investors. Finally, Dell and HP stocks plummet up to 8% as a brutal profit squeeze rocks the AI sector. The AI boom was a guaranteed gold rush, but a hidden cost bomb is now exploding. Why are skyrocketing memory prices not GPS, the new choke point threatening the entire industry? Listen up, market tremors are shaking the foundation. As tech stocks take a nosedive, the Nasdaq just plunged 1.2%, sending shockwaves through the market. I'm telling you, today's action is an escape signal. You don't want to be caught on the wrong side of this trade. Here's the rundown. The S&P 500 dropped 0.92% to close at 6,734.11, while the Dow lost 0.65%. What fueled this sell-off? The Fed's shifting stance on rate cuts is the big story. Just a few weeks ago, the market was betting on a near certain December rate cut, but now those odds have plummeted to around 41 to 50%. The 10-year Treasury yield spiked to 4.14%, compressing valuations and rattling growth stocks to their core. With the VIX volatility index climbing to 20.0, it's clear that uncertainty is the name of the game. Let's break this down. First, the Fed's mixed signals are causing chaos. Governor Waller is pushing for a rate cut, citing labour market fragility and inflation stability, but Vice Chair Jefferson warns against rushing, highlighting persistent inflationary pressures. This internal Fed tug-of-war has left the market confused, triggering a repricing of rate expectations. Money's fleeing high multiple tech stocks, seeking shelter in more defensive plays. Second, capital flows tell a compelling story. Institutional investors are pulling out of tech at an alarming rate. The Nasdaq saw a whopping 851.96 million shares traded, a clear sign that big money is taking cover. Meanwhile, the Dow's smaller decline suggests a rotation into large cap defensive names. Financials and industrials are benefiting from this shift, with XLF and XLI showing relative strength. Third, valuations are under the microscope. The tech-heavy Nasdaq's drop highlights a critical P divided by E repricing. Companies like Nvidia and AMD are facing the heat, with semiconductors leading the decline. Nvidia, in particular, is on watch ahead of its earnings report this Wednesday. If growth guidance falters, expect a further 10 to 15% correction. I'm telling you, cut tech stocks immediately and rotate into financials today. Now, let's talk sectors. The tech sector, led by semiconductors, is getting hammered. Nvidia, AMD, and TSMC have all tumbled 2 to 4%. Even software giants like Microsoft and Salesforce are feeling the pressure, down 2 to 3%. Conversely, financials like JP Morgan and Bank of America are in the green, buoyed by the higher rate environment that expands net interest margins. The XLF EDF climbed nearly 3%, with regional banks showing resilience. Good advice makes you rich, bad advice costs you a fortune. Listen to me, act now. Short-term trim tech exposure by 15 to 25% and overweight financials by 5 to 8%. Target instruments include the XLF, and individual plays like JPM and BAC. Keep an eye on the 10-year yield. If it breaks below 4.0%, it could signal a reversal and a potential re-entry point for tech. Hedge with SQQQ for those seeking advanced protection, or PSQ for a less leveraged option. For the medium term, establish a 3 to 6 month accumulation plan for quality large caps. Microsoft, Procter & Gamble, and Johnson & Johnson are prime candidates. Set monthly buys at current levels, leveraging the dip for long-term gains. Defensively, hold cash reserves or employ protective puts on SPY or QQQ, especially if the VIX spikes above 25. This will shield you from unexpected volatility and provide flexibility in reallocating positions. In closing, this isn't the time for complacency. The landscape is shifting and smart money is already realigning. Keep your eyes on the prize, with the Nvidia earnings and retail reports later this week serving as key indicators. Time's ticking. Let's dive deep into today's critical market dynamics. That market volatility we're seeing might just be the tip of the iceberg. One of Wall Street's most respected voices, Double Line Capital CEO Jeffrey Gundlach, just went on the record with a bombshell prediction. The next big crisis in the financial markets is going to be private credit. He's targeting the massive $1.7 trillion market that lends directly to companies outside the traditional banking system, saying it's now filled with garbage loans. This is where the situation takes a more complex turn. A huge portion of these loans are now covenant light. Covenants are normally rules a borrower must follow, acting as an early warning system for the lender. Stripping them away means a lender might not know a company is in deep trouble until it's far too late. Believe it or not, he says the market has, quote, the same trappings as subprime mortgage repackaging had back in 2006, drawing a direct line to the lead up to the 2008 financial crisis. That comparison is powerful because just like subprime mortgages, this potential crisis is brewing in the so-called shadow banking system outside the view of many regulators. A sudden blow up here could blindside everyone. His warning doesn't stop there. The veteran investor also calls the current stock market one of the least healthy he has ever seen, pointing to speculative excess in AI-related stocks. Now, get this. That AI spending is incredibly concentrated. Just a handful of tech giants are responsible for the vast majority of capital expenditure. Unlike the dot-com bubble, which was spread across hundreds of companies, a spending pullback by just 2 or 3 of these giants could crater the entire supply chain. If the promised AI profits don't materialize quickly, the shockwave could be immense. The core conflict is now escalating as Gundlach slams the push to sell these private credit funds to retail investors. He calls it a perfect mismatch. Many of these investments are packaged into vehicles like interval funds for ordinary people, which only offer to buy back shares periodically. The assets inside the fund are illiquid, hard to sell quickly, but the fund promises semi-liquid access. If a market panic causes a rush for the exits, the fund could be forced into a fire sale, triggering a downward spiral. The situation presents a fascinating duality. On one side, you have a seasoned billionaire urging extreme caution, advising investors to keep about 20% of their portfolios in cash. On the other, the broader smart money consensus is doing the opposite, with a recent Bank of America survey showing fund manager cash levels at a low of 3.9%. It's a clear split in conviction. So what should we watch for? Keep an eye on default rates for private corporate debt and any changes to AI spending plans in big tech's upcoming earnings. These will be the first signs of whether Gundlach's stark warning is about to become a reality. Speaking of the immense pressure building in the AI sector, a major warning shot was just fired on Wall Street. Tech giants Dell and Hewlett-Packard Enterprise saw their stocks plummet, dropping 8% and 7% respectively in a single day. What really brought this to a head was a sweeping downgrade from Morgan Stanley, which hit 7 computer hardware companies. Dell was slapped with a rare double downgrade, slashed all the way from overweight to underweight. It signals that the initial frenzy of buying any stock related to AI is over. The market is now getting far more discerning, punishing companies that, despite being exposed to AI, have weak profitability profiles. The bank is warning of an unprecedented pricing supercycle that puts the entire data center boom at risk. But if you think that was just the appetizer, the main course is the brutal profit squeeze happening behind the scenes. We're talking about a company's gross margin, the percentage of revenue left after subtracting the cost of making a product. Morgan Stanley's analysis shows they've had to slash their gross margin forecast for Dell in fiscal year 2027 by a whopping 220 basis points. In other words, revenues from AI servers might be going up, but the actual profit Dell gets to keep is going down. The core of the problem is memory chips. Costs for DRAM and NAND memory are skyrocketing, with Samsung reportedly hiking prices by as much as 60% since September. Interestingly enough, this makes memory the new potential choke point for the entire AI industry. For the last 2 years, all eyes were on the GPU supply. Now, surging prices for high-performance memory are becoming the primary bottleneck. The real winners here aren't the server assemblers, but the handful of memory producers like Samsung and Micron who control the supply. The supply crunch is so severe that analysts warn memory fulfillment rates could fall as low as 40% over the next 2 quarters. A major part of this fragility comes down to geography. As of 2025, South Korea and Taiwan will account for about 75% of the world's entire memory chip production. Any disruption in that region could seriously derail the AI build-out in the US and intensify tech competition with China. This isn't just a forecast, it's a replay of a nightmare scenario from 2016 to 2018 when a similar memory price spike crushed hardware profits. So why can't companies like Dell just pass on the higher costs? It comes down to what you could call the AI customer power paradox. Their biggest customers are the giant cloud companies who have immense negotiating power that erodes profit margins. So Dell sells more servers but can't fully pass on the exploding costs. Morgan Stanley's conclusion is blunt. History shows that companies facing these margin headwinds underperform. The key indicators to watch will be the gross margin figures in upcoming earnings reports from Dell and HPE, along with contract prices for DRAM and NAND memory. That will be the true test of whether the AI hardware rally's foundation is starting to crack.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.